Hello, my name's Holly Mackay and this is my assistant Mog. Many people are not confident about investing, but with interest rates dismally low today for savers, I think it's worth at least understanding the basics of investing to think about if it's suitable for you. So what is a share? People talk about shares, other jargon includes stocks, and sometimes the industry talks about equities. Well, owning a share is literally owning a teeny tiny piece of a business. Now, if that business does well and the share price goes up, you benefit. If the company runs into trouble and the share price goes down, you could lose some money. Now, people on the news, you may have heard talking about the FTSE 100. No, that FTSE is not the floaty game you play under the table. It's actually just a list of the biggest 100 firms in the UK which have shareholders. Some of the members of the FTSE 100 are on this board here behind me, names you'll be familiar with. Don't be bamboozled by the stock market. It's just a market like any other anywhere else in the world. You have people buying stuff and people selling stuff. But on the stock market, they're buying and selling shares. I think of it a bit like eBay. The sellers make offers and the buyers make bids. So, the FTSE 100 is just a posh description of a list of 100 shares, and the stock market's just like eBay. The tricky bit is trying to decide which stock or share to buy. Now, quite often, even the investment boffins who spend all day at their screens staring at this stuff get it wrong. Take Tesco, for example. You may have heard that they've been in the wars recently. Well, last year they were cruising along doing fine, and then an analyst turned around to the market and said, you know what? We sort of thought we were going to make a bit more money than we're actually going to. Sorry. Stock markets don't like surprises. Bang, the Tesco share price tumbled. That's just one example of how even the experts get it wrong. But don't panic. If picking individual stocks and shares is not your thing, there is an easier alternative. If you're a less confident investor, then I think investing in a fund is a good idea, and I'm going to explain what a fund is using a cake analogy. Confident stock pickers will go to the market and they'll pick their own ingredients for their investment portfolio. They might chuck in an egg, oops, they'll put in some sprinkles, whatever it takes to bake their investment cake. But if you're less confident, then some people employ the services of what we call a fund manager. So what do these mythical fund managers do? Well, think back to those FTSE 100 stocks I told you about earlier. They'll look at the stocks, pick the ones they like. Banks, I might have a bit of exposure to the banking sector. I'm more keen on EasyJet. People are taking lots of holidays these days. BT, they're going digital. They're going to win. ITV, no one's watching telly anymore. I'm going to leave that out. Don't take my word for it, that's just an example. They'll then bake their investment cake, if you will, and say to the investors, here is what I have made for you. There are about 50 typically stocks in here. You can buy a unit of my fund and it saves you from having to pick the individual elements yourself. So how much am I likely to make by investing in the stock market? Well, that's the million-dollar question, and the truth is, no one can tell you for sure. Shares are volatile, they bounce up and down all over the place. Let's take some examples. If you'd invested in the FTSE 100 5 years ago, let's say you'd put in £1,000. Well, today you'd be sitting on a £450 profit. If you'd invested the same £1,000 3 years ago, today you'd have made about £315. But had you invested 12 months ago, you'd be down by about £10 today. So shares are volatile. You need to think about investing, experts suggest, for at least a 5-year period. Let's examine why. Remember the dreadful year that was 2008 for investing. Share markets plummeted. The UK FTSE 100 fell by about 30% in 1 year. So if you'd invested £1,000 at the beginning of the year and you'd needed to take it out of the stock markets at the end of the year, you would have lost about £300. So be careful, be sure you're in it for the long term, and be prepared to take the ups with the downs. So where can I go to buy funds? Well, the first rule is don't go direct to the fund manager because you'll pay more than you need to and the service is often not as good as you could get elsewhere. I like to go to what we call platforms. These are like online department stores. You can buy funds from lots of different fund managers there under the one online roof. If you're a less confident investor and you want some hand-holding, some guidance, some indication of which funds are good ones, then I like Best Invest, Fidelity and Hargreaves Lansdown. If you've got some shares too, then I think it's also worth having a look at Charles Stanley and the Share Centre. If it's just price you're after and you're really out for the best deals this year, AXA has waived its fee until May 2016, and if you've got more than about £30,000 to invest, Halifax's iWeb is, to use technical language, cheap as chips. So how much will buying funds on an online platform cost me? Well, although the specifics depend on where you go, as a rule of thumb, you can expect to pay between about £12 to £15 each year for every £1,000 you invest. That covers the fund manager's costs and the platform costs. I hope that's been a helpful introduction. Thank you very much for watching. I hope it's been less exhausting for you than it has been for Mog.